We can start letting people in. Hi, everybody. Welcome. We're just going to wait another minute or so to let people join. In the meantime, though, if you would like to introduce yourself, feel free to drop in the chat your name and maybe where you're from. Oh, we have a couple of Floridas. Welcome, welcome. Definitely warmer than where I am, that's for sure. Wisconsin, that's probably closer to my weather. I'm based in Toronto, Canada.
We've got some Florida and Georgia. That's closer to me, so.
Cold and storming. Sorry, Katie. Melissa Adams from New York. Welcome. All right, I can still see people trickling in, but I think we'll get started because we're a minute past the hour. All right. Hi, everybody, and welcome to today's Work of Design live webinar brought to you by Studio Designer. If you're brand new here, Studio Designer is the all-in-one platform built to help interior designers run more efficient, profitable businesses. From managing projects and finances to keeping client communications on track, we help make the business side of design feel a little less overwhelming. I'm Jamie, and I'm part of the marketing team here at Studio Designer. We're so excited to have you join us for today's session. Today, we're going to be diving into a critical topic, revenue recognition. When and how you recognize income in your business can significantly impact your profitability, and our expert guest today is here to break it all down. I'm really excited to introduce Michelle Williams, financial strategist, business coach, and founder of Scarlet Thread Consulting and Matrix Solutions. Michelle has helped countless creatives own their numbers and align their financial decisions with their business goals. Michelle, before I pass it over to you, just a couple of quick housekeeping items. For everybody in the audience, feel free to drop your questions into the Q&A box as we go. We'll also have time for a Q&A at the end. This session is also being recorded and it will be sent to all of you. So if you need to step away for a couple of seconds, don't worry, you won't miss anything. All right, Michelle, I will pass it over to you. Oh, looks like you're on mute, Michelle.
Is that better?
That's better. There we go.
Really hard to go through an entire webinar with no sound. That wouldn't work. Awesome. And can you see my screen okay?
Yes, all good.
Okay, great.
Thank you.
All right, let's go ahead and jump in. I am excited to be with you today. And Jamie, thank you so much for having me. I will go ahead and let everybody know that I've had laryngitis for the last 5 days, and I'm just getting my voice back. So I have done everything that I can to be able to be with you today. I've got a cup of tea with honey, I have cough drops, I've taken cough medicine, and I have water. So I've done everything, and I just ask that you'll bear with me as we go through. The information was so important and such an interesting way to think about our numbers that and coming right off of tax season that I didn't want to have to cancel it if I could help it. So thank you for having a little bit of grace as we go through it. Okay, so today we're going to jump in and look at exactly what Jamie said, revenue recognition, how it impacts our profit, why it matters, and what we're going to do about it. And we're going to talk about why it's so important to think about this. So here are the 4 things that we're going to be going over today. Where revenue can be recognized in your business, how these decisions impact your profit margins, the advantages and trade-offs of each method, and tips for aligning recognition with your workflow. Really important. For those of you that already work with Studio Designer, you know that process is so very important. Even if you're with Mydoma or Studio or any of the project management tools, having a process is really what supports you being able to do your work, to depend on when the money is coming in and depend on when the money is going out, so that you know what the flow of work and the flow of money and dollars and profitability looks like in your company. So we're going to play on that for a little bit today. My name is Michelle Williams. For those of you that may not know me, I am a wife, a mom. I am now a grandmother to 2 sweet little grandbaby boys, one as of Sunday. So we're so very excited. As I say, I'm a sister, a friend, a coach. In other words, I have a very well-rounded life like all of you do. And what's so important to me is that the time and the effort that I work and that I spend in my business, I want to make sure that it counts. And I want to make sure that I know how much money I'm going to have to make the decisions that I need to make. Even yesterday, I met with my accountant to go over the first quarter of my business and to start anticipating quarters 2, 3, and 4, and then even a yearly outlook. So we were planning on how much was going into my 401k, how much was going to be going into other retirement plans, what was going to happen, how much am I paying myself, who am I hiring, what are all my outlooks look like for this year. And the truth is, I cannot make those financial decisions in a bubble. I am having to make those decisions along with the work that's coming in and when will cash be available. And for you, the same thing holds true. We can't make decisions financially in a bubble. They have to be made along with a strategy so that we know where we're going and what's happening. And so that's what I'm here to help you do. I did mention, and I think Jamie mentioned it as well, rather, that I'm the owner of Scarlet Thread Consulting and the owner of Matrique Solutions, which is a software platform dedicated to financials that steps alongside Studio, alongside QuickBooks to help you have deeper understanding of your financials, modeling tools, and things like that that can help you decide where your business is going. I also have a podcast you can check out, Profit is a Choice. Okay, let's jump in and talk about revenue recognition. These words sound big, but what it really means is, when do I say that the money is mine? That's what revenue recognition means if we boil it down to kind of layman's terms. When is the money mine as the company owner, and when can I spend it? Versus when am I being a steward of the money for my client who is giving me this money to do something on their behalf? And so understanding what revenue recognition is and understanding that it definitely makes an impact on how we run our business is important. I do want to remind you, you are welcome to stop and ask questions at any point as we go along. As I told Jamie before we started, I know that sometimes when we have financial conversations, if we don't get an answer early, it starts to spin. So please feel free to use the chat and go ahead and ask anything. And Jamie will stop me at a point if I don't stop on my own to make sure that you have understanding. So when we're talking about revenue recognition, we also have to take into account cash versus accrual accounting. In cash accounting, revenue is recognized when payment is received. So it really follows the bank account, money in, money out. So if the money came into the bank, then we count it as revenue. If the money went out of bank, we count it as a bill paid or as an expense, okay? However, revenue can be recorded very differently in accrual. And also in cash, we can have something like deferred revenue, which would then show up as a liability. So if somebody paid you money and you were not yet going to use that money, you might see it as a prepay, a deposit, or a retainer. And those show up as liabilities on a balance sheet because it is payment for work that has not yet been done. But in a straight cash accounting model, money coming in, money going out is what we're looking at. In an accrual model, it's a little different. We are recognizing revenue based on when the sale is earned. And I want you to think about the word earned, meaning when are goods or services delivered? When is everything performed? It's not about payment received. I like to say accrual accounting is promise to pay and promise to be paid. So you're looking at it a little bit differently. Now, here's what's interesting. When I say earned, that's the word that if there was anything on this slide, I would tell you to circle. It would be that word, because that word can mean something different to each of you. When do you consider it being earned? If we look at it in the cleanest way possible, okay? So what I'm going to be talking about is a continuum or a spectrum, if you will. If you put cash accounting on the left, money in, money out, and you put the most far view of accrual accounting on the right, then that would mean when you had completely done everything to wrap up and complete the sale, which for most of us would be we've been to the install, everything's been delivered, all of the cleanup has been done, and we are no longer working on this project with that client. That is the other end of the spectrum. So one is yes, and here's money. The other is everything has been completed. And then you can understand that the word earned can then show up in multiple places along that spectrum, which is what we're going to look at. You'll notice on the slides, I have like a little clipboard with a strategy on there, like you're doing a football play or something. That's going to give you a clue that as we're moving through these slides, this is the time that you have to make a strategic decision in your business. Because what we see with GAAP, which is generally accepted accounting principles, is that once you make a decision on how your accounting is going to be done, we have to stay consistent with every job we do. Meaning, you cannot recognize revenue in a cash way and then recognize it differently somewhere else, like as an accrual. When we are reporting in one method, cash or accrual, and we need to keep that process consistent. Now, it doesn't mean that if you're in other accounting software outside of Studio, you can run your books in cash and in accrual. You can run the reports in both ways to see what's happening. Studio offers accrual only reporting. So you can build other reports to give you more cash analysis. But in general, if you're in Studio, you're going to be running in accrual accounting and looking at your numbers in accrual. So what that means is you have to first make the decision, cash or accrual, and then you're going to make other decisions as we go through. Before I move on, Jamie, are there any questions about cash or accrual? All right, it doesn't sound like there are. So I'm going to move forward. If so, we can always go back. So what does it mean then to earn revenue? We're going to talk primarily in accrual accounting here, because in the cleanest version of cash, we know what it means. Cash came in, cash went out. What it also means, though, is that the invoice follows it. So in cash accounting, we would create that invoice the minute that money came in so that we could recognize that revenue. When we're in accrual accounting, it's really coming down to when are we going to create an invoice and recognize the revenue? Remember when I said circle the word earned? And so now let's talk about that. What does it mean? So in accrual, it's recognized when the company fulfills its obligation. So when do you believe that you have fulfilled the obligation to the customer? Is it when the product is ordered? Is it when the product is shipped? Or is it when the service is provided? And so your second strategic decision is when is your company going to say that you've earned revenue? What you're going to see as we move forward is some of the different places that revenue can be recognized. So let's look at them, and you can start to ask yourself, in other words, when do we create our invoice? At what point in the process do we create an invoice? We're going to talk about in a minute, based on when you create it, what can happen around that. But here's why this is important. I have seen companies get into immense trouble when they don't have a firm understanding of how this works, so that they are not very clear on when they are recognizing revenue, which also means you get to recognize profit. The goal, if you were looking at it to keep your accounting clean, is to recognize the revenues and the expenses associated with that sale, i.e. cost of goods, in the same time frame as much as possible. Because then when you look at a P&L, you can see money in and money out in the same time frame. What gets you kind of messed up with your accounting is when you recognize revenue one month. So let's say that we say the money came in January, but we don't recognize all the expenses that went on to that job until September. Well, now the income came in January and we recognized it, which means we could potentially spend that money on all kinds of things. And then when September comes, we don't have the money to make the payments that we need because we took the money into the company to spend as company money too early. Think about it as if you are not segregating and separating your money out to allow it to do the job that it's meant to do. It could accidentally do the wrong job by being used up before the time comes that we need to use it. So all of this is important, of making these very clear decisions in your business on when are you going to do these things. So here,
Michelle, sorry to
yeah,
interrupt you. We have a
that's okay.
question from the audience from Rhonda. She says, and maybe you'll get to this in a little bit as well,
Okay.
but cash or accrual, you have to pick one and stick with it. What are the benefits of one over the other?
Well, yeah, that's a good question. So the benefits of one over the other. Cash, the benefit is businesses that do work very quickly, like a quick in and a quick out, are going to most likely do cash. Businesses that don't hold inventory are going to do cash, because what that means is money came in, money went out, I'm done. And so you're not having to carry things for months over months over months. There are some I would say smaller accounting firms that run on a cash basis because their jobs are quick, they're in, they're out. So it's easier for accounting, it's easier for cash management, and it's easier to compare what's happening on a P&L to what's happening in a bank account. They kind of mirror each other. The more complex your business gets, though, for example, the example I was giving, where you get paid in January, all of the money up front, but you're not paying out expenses until September. Well, some companies don't want to take that money in, pay all the sales tax, have that money as income in January when they've got like 9 months of expenses and work coming out of it. They want to wait and show that that money came in and that they recognized it as they have earned that sale at the same time as the expenses. So when jobs start to take longer, I usually, my rule of thumb is if they start to take longer than 2 to 3 months, you might want to consider accrual accounting. Again, in QuickBooks, you can state that you are cash accounting or state that you are accrual accounting and still run the reports in either of them so that you can see the difference in how money is being moved. In Studio, it is accrual only. And so that's the only option that you have with the normal generated reports. But from a business standpoint, I would say that if your business is quick in, quick out, cash accounting, and you're not carrying a lot of inventory, cash is usually going to be the better option, just because it's easier and cleaner. If you are running business where the sale, and when I put sale, I'm putting that in air quotes, what you consider the sale runs months over months, then accrual might be best so that you can choose when to show that revenue is coming in as income and you are actually recognizing the profit on it. Did that answer it for her?
Thank you.
Okay, so in an accrual world, let's look at some opportunities for where revenue could be recognized. It could be recognized when the initial order is placed and money is received, like cash accounting. So this would be, you went to the house, you gave them a scope of work, you gave them let's say a furnishings plan. This is all the things we're going to do. They sign on the dotted line. They give you $100,000 and you come back and you create an invoice at that moment. So really this is about when is the invoice created, because when the invoice is created is when we are recognizing revenue. Generally, we're not recognizing revenue and profit on a proposal or an estimate because those have not been recognized as revenue. They do not show up on a profit and loss statement. What shows up on a profit and loss statement as revenue being recognized as being earned by the company is only in the case of an invoice being created. Okay, so keep that in mind. So that's the first place that we could do it. A second place, and this is not an exhaustive list, this is the most common ones. And I have had clients over my 15 years doing this that have done it at every one of these points. Okay. The second point, some people recognize it when they order the product. So when they order that product from their vendors, they create the invoice at that moment so that they can start to move that money into company-owned money versus money that they are putting in client deposits or holding for the client. They go ahead and create the invoice right there. Another place is when the product ships from the vendor. So some people don't do it at the moment that they order it, but they do it when the vendor ships. So when they get that information back from the vendor that says, I have shipped your product to you, they go ahead at that moment and turn it into an invoice. I've also seen them do it when the product arrives at the warehouse. So they're not doing it when it's ordered. They don't do it when they get the information from the vendor. They get it when the warehouse calls them and says it's been received. Many people will then turn it into an invoice right there. The next time that I see it is when the install is scheduled, but prior to the date. So that might be sometime after it has arrived at the warehouse, but prior to the install. So that might be when the designer calls and says, hey, Jamie, your install has been, on the books, and we're just calling to confirm that it's next Wednesday. And so we're going to send you your final invoices or, some of the invoices right now. What they may do is turn them into invoices internally and go ahead and match all of the dollars that maybe they're holding in client deposits before they go to the house. Some then might do it when the install is complete. So after they've gone, they've done all the installations, they've come back to the office, they're doing their final paperwork, and they turn everything into an invoice at that point. So prior to that, they would have been receiving money on proposal. And you can do that whether you're in Mydoma or whether in Studio or any other project management tool, regardless of how you're managing this, whether it's QuickBooks or in Studio. This is more of an accounting decision about what do I do with money that's coming into my business. And here are some things to think about. Number one, I said we recognize revenue by saying when we've earned the sale. So in your business, it's about making a determination on when have you earned the sale. At which part here are you saying you've done the work to earn the sale? Remember when I talked about the continuum? You should be able to see the continuum right here. From the moment that the client gave me money, all the way down to the moment that I gave them the product. Because the truth of the matter is, how would we feel if we're sitting in the client's shoes? When would we think the sale is complete? We're not going to think the sale is complete until we've gotten the goods and services, right? But if you're sitting in the business side, if we're saying we can't recognize profit and we can't use the profit in the money, then that means we can't use it until the very end. And most businesses will struggle with that. I would love it if you all did it that way, because then the profit's the gravy and you've built enough in to run the business on. But not many businesses are that clean with the way that they run.
Michelle, I have a quick question from the
Yeah.
chat to clarify something that's on this slide. So the question is, what is the difference between the initial order and when the product is ordered? So the first
That
two
means,
points.
yeah, that's a great question. What I mean by that, and I'm happy to clean the screen up or the slide up if it makes it more clear. But it's kind of where I said it's cash accounting. It's the minute the client, and I think one of the next screens will make it a little more clear, but it's the minute the client hands the money to the designer.
Wonderful. Thank
Right?
you.
Because we know that the designer might get a check from a client or, an ACH or a wire transfer or credit card payment or however you take payment. We may get that money, but we may not place that order for a week, a month, 2 weeks, whatever, as we're working out those details. So there could be totally different points in time.
So it's when the client is confirming it with you as the designer.
Correct. It's when they are giving you money. It's money changing hands.
Perfect. Thank you.
Okay. Any other questions, Jamie, before I move forward?
Yes, there is one other question.
Sure.
Can you recognize product income separately from design fees? For example, when ordered and design fee on a monthly basis based on the hours worked. So I think the question is, can you recognize them differently?
That is an amazing question, and absolutely you can, and I also believe that you should. So what I think is the best way of doing it is that when you provide a service, whether it is a draw from a flat fee or whether it is so this works whether you've taken a huge retainer as a flat fee and you're drawing from it, or whether the client is actually paying you because you've sent them a time billing. That revenue should be recognized in the time that you did it. And for most people, it is. So we are saying that is a service. We have completed it. We've created an invoice for that right now. And so that money for services rendered is normally the money that I like to have a company running on in the day to day, letting the profit on product be the extra. So if you can look at, this is a whole different webinar, but if you could look at what it takes to run your company on a monthly basis, if you can cover that in some type of time billing or design fees, you're going to be much freer to breathe than if it has to always be covered by profit on product. So yes, I would separate them. I also would separate them on invoices. So I would never, if I could help it, put services completed on an invoice with product. I would always have my product invoices separate from my service invoices for that reason. And additionally, because of how I do profit first and use different bank accounts, I'm going to want to segregate that money because it's got different jobs to do for some amount of time. Was there any follow-up to that, Jamie, or is that
No,
good?
thank you very much.
Okay. So our next slide is revenue recognition and financial reporting. So when we're looking at a profit and loss statement, remember I said that revenue or income only shows if there is an invoice that has been created. And this is regardless of whether you're cash or accrual. Like we're not showing proposals on a profit and loss statement. So it's not going to show there. Estimates and proposals are just not going to be on the P&L. You're going to see those more on a WIP report or a work in progress report. So if you've received funds on proposal and not yet created an invoice, you're going to need to go look at that report. You can also see money that you have either in client deposits. You might see it in other software as retainer accounts, but those are going to be in the liability section, because what that's saying is there is work that you have to get done that you've taken in money for that you've not, in air quotes, earned yet. So it's a liability, meaning your company owes the client the service or the product that you promised for the money that you took in. So really what we're doing here is trying to say, when does that money sitting in that liability account get to move up to an asset account, move into our bank account so that we can spend it for the running of our company? In the grand scheme of things, if you were to look at a profit and loss statement, your income minus your cost of goods gives you gross profit. And gross profit is so very important. What I love about that gross profit number and why it is so important is it is the money that we have to run the business. So if you don't know what that gross profit number is, you are actually hampered by knowing what it is that you have to run the company on. So I would never just want to look at total revenue and then look at the end result. I want to know all the way down that P&L where the money's coming from. Cost of goods is the money coming out that is used to be able to pay for product. And so what we're talking about here is I'm getting all this money up front. How do I know how much money is mine? How do I know how much money is owed to a vendor or owed to a client? And where does my money go? And so being able to separate out and segregate the money first in our strategy for how we are implementing any product, whether it's Mydoma or Studio or any other project management tool, we absolutely have to have a strategy for implementation. Without a strategy for implementation, we run the risk of doing things all willy-nilly or outside of a process, and you will get yourself so twisted up. And so just being very intentional about how does our process flow? How does our work flow? How does our cash flow? How does our communication flow? When do we recognize revenue? When do we recognize this is a liability? That's the conversation that every company needs to have internally. And even if you've already implemented Mydoma or Studio, there is still time. We still need to stop and ask, are we running it in a way that makes sense for the way that we run business through our company, the way that we're recognizing cash, the way our bills come in, all of the things? If not, then what happens is often we don't have money and we're always taking money from the next job to pay for bills in the past, which is what we, lovingly call robbing Peter to pay Paul. And that is a miserable place. That is a miserable place to be. Or we have all this money sitting in the bank, but we don't know what's ours and what we can take. And so really starting to dig into the numbers and understanding what they mean, understanding what is gross profit. In Profit First, we call that real revenue, meaning that is the real revenue that I have to run the business on. That the revenue that comes in or the income that comes in from sales, that first has to be managed to take the cost of goods out so I know how to manage it with the vendor. After that is about managing it internally, okay? So understanding how these things show up on either a balance sheet or a P&L will give you so much confidence in the running of your business from a financial standpoint. So let's talk about profit for a moment, because the whole goal here is recognizing revenue and seeing how profit goes with it. So at first we said that when we recognize revenue, we are actually creating the invoice, which also means that we are then taking any money that would have been sitting in a liability account if you had gotten paid in advance and moving it up to the asset account. So now we're going to start seeing that money in your day-to-day bank account, the bank account that you use to run your business, which is separate, hopefully, from the bank account that you're holding your client funds in, okay? My hope is that each of you has a bank account for client funds that is separate from the bank account of your business management. If not, we are commingling those funds, and that can get really, really shady very quickly. So, like I said earlier, a company is managed based on gross profit or real revenue, which is the money that is left to run the company after you've removed your cost of goods and your services. And in the cleanest of accounting, notice I keep saying the clean way. Remember, back to that spectrum or that, that continuum, if you will. Profits are recognized when revenue is recognized. All right, so what does that mean? It means, when have you earned it? When does your business consider the sale complete? When did you create the invoice? Now you can recognize profits. What I see is people taking the profit on a sale in January, spending that profit in February to run the business. And then when September comes and they're closing out that job, they have no profit from that job because they took the profit prior to recognizing the revenue. So they've got all their processes off. Their revenue recognition is not following, or profit recognition is not following their revenue recognition. When that happens, you can get easily twisted up and start having large amounts on a credit card, large balances, the money, you feel like you're always just scraping by. And so when we can start to streamline our process so that when the money comes in, everything flows together, it's going to make more sense to you. The other thing we have to recognize is that when you create an invoice in most states, you have to also pay sales tax at that point in time, which is why, especially in accrual accounting, people are sometimes delaying when they create that invoice so that they don't have to pay sales tax. But by delaying the invoice, you're also delaying when you have access to the profit that goes along with that invoice. So again, back to strategy, you have to ask yourself, when do we need to recognize revenue so that we can recognize profit? Understanding that by creating that invoice and recognizing revenue, we now have to also make a sales tax payment. And I don't want you to be afraid of making a sales tax payment and something changing, because I hear that all the time. Oh my gosh, well, I can't recognize it too early. Whenever that is, if it's anything other than at the last minute when you're closing out that file, something can shift and change. As long as you are keeping up with sales tax properly and you are keeping up with what you've paid in based on how much, it is not that difficult to create an entry. If you do not have a good bookkeeper who is keeping up with that, then it can get hairy. So as long as you are keeping track of what is happening, creating, offsets to that sales tax account is not difficult and can be managed very easily. The other thing I'll tell you is the rules are different in every state for when you can pay sales tax, get your invoices, and recognize revenue. So please, 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 I am not an expert in what every state does. There are some states that require you to create the invoice the minute the money changes hands. And other states allow you to choose a place in that process of when you've earned that income. Please, please, please know the rules of your state, and make sure that your accountant and bookkeeper know those rules and follow those rules. And if you are doing work across states, make sure you understand Nexus and talk to your bookkeeper or accountant about Nexus so that they can help you keep all of this in alignment in case another state's requirements for when you create invoices and receive revenue are different than the state that you're currently in. All right, I see questions coming in, so I'm gonna stop and let those go through.
Yes, we have a question from Christine. So I'm going back a little bit to invoicing, time billing separate from product. Christine says she bills a flat fee for design fees. However, she collects it in intervals. So she does the first 50%, then 35, then the final 15.
Okay.
She asked, should I invoice for that all separately or create a proposal for the entire fee and then collect it at intervals? The second part of the question is, how does that affect my earnings and sales tax?
So if this is, there are a couple questions there. First, I would say if you want to show from an accrual basis that you are going to, let's say, have $50,000 in a flat fee for time billing. It was time billing, right, Jamie?
Yes, it was time billing. Yeah.
Okay, so let's say there's $50,000 and you want to show that you're going to get all of that in. You could absolutely put it on proposal and then invoice it in increments. You could also create different invoices if you wanted to do it. There's not a right/wrong way, but it's about how do you want to see it. If you are doing full accrual accounting and they've agreed to that and they know it's coming in, there is nothing wrong with creating a proposal and then invoicing parts of it, doing, gosh, I've lost the term, progress invoicing. Okay. The second part of the question was about sales tax. In some states, many states, sales tax is not reported on time billing or on work. In some states, it is if it's on an invoice with a product or if it's tied to a product. So that's where you're going to need to know what it looks like in your state, to know what that looks like. Read that last part of the question for me again, Jamie, or is it in the chat? I can always look at it if it's in the chat.
No, I can read it. So, she does the progress billing, 50%, 35, then 15. She says, should I invoice that all separately or create a proposal for the entire fee and then
Okay.
track that in intervals?
Okay. I think we answered that piece. The one thing I will say is this. To me, when you take a flat fee, let's say you took that first 25,000 and you created an invoice and you were able to mark that as income. What most people would do is they might take all of that at one time. You could then take that $25,000 that they pay you, put it in a retainer account, and then make sure that you know how much time billing allows you to pull that out. Let's say that 25,000 has to last you for 3 months worth of work. Some people would then take the proposal, take the 25,000, and then they would invoice each month off of that 25,000 for the work that they had done, so that then they recognized it in the month that they did it. Some people would take the whole 25,000, mark it as revenue the first month they got it. I'm more of a fan of doing it, putting it in a retainer account, and knowing that you have to keep up with time billing internally to use that money, or milestones, because that makes us aware of what it's actually taking us to do it. Any other questions around that, Jamie?
The last part of it was, how does that impact sales tax?
Yeah. And again, if you're in a state where time billing and design work is not taxed, then there's no implication to sales tax. If you are in a state that requires that work, that service work is taxable for some reason, I know Florida is a little weird with some of that, then you're going to pay sales tax when the invoice is created.
Wonderful, thank you.
You're welcome. Are there any other questions?
No, not that I can see.
Okay, thank you. Okay, so you can see here the big company, or the big question, the strategy question is, when will I recognize profit and allocate profit in my company? So we've had to make a strategy decision on a couple of different things already. And this is where people get in trouble. They take a great system like MyDome Studio or any of them. Heck, Asana, QuickBooks, I don't care what the system is, Matrique, they take it and they just jump in and try to start entering data without sitting down and strategizing, being extremely intentional about how does work flow through my company? How does the process flow in my company? Again, communication, cash, all of it, because it all fits together so that you have the resources you need at the time that you need them. I want to align the same way I want to align the product payments to the vendor with the income that I'm getting so that they match when I'm looking at that P&L. I personally want to match time billing. Here's what I billed and here's the time that we worked. If not, it gets off and then it starts to look like these high highs and low lows on your profit and loss statement, and it gets harder to manage the day to day. So making the decision for cash or accrual, making the decision on when you're going to recognize revenue, making a decision on when you're going to recognize the profit to make sure that it's following that, and keeping all of things together is what's going to make companies work in a way that allows you to sleep at night and have less stress. Here's some comparisons. Here's a visual, okay? Let's say that you sold a furniture package for $100,000. The cost of goods are $63,000 and the gross profit on the sales $37,000. I love word problems. This one's easy. The cash was received April 1st, the full 100,000. They paid you all of it in advance, but you're not installing it until August the 15th. If you look at this chart, it's going to show you the different places that you could recognize revenue, thereby recognizing the profit, okay? Because they go together. So if that's the case, then if I were to recognize it at payment, when I got that payment, then in April, my company made $37,000 in profit off of that job. This is gross profit. If I don't recognize it until I ordered it, and I don't order it until May, I can't recognize the $37,000 in profit until May. So now it looks like I made it in May. If I invoice it when it was shipped and it doesn't ship until June, I can't recognize it until June. That means I can't spend that $37,000 and consider the fact that my company has earned it until June. So if I spend that money in April or May, but my books don't show that I earned it, then I'm robbing Peter to pay Paul. July, let's say that I invoice when it arrives at the warehouse. And then the last two, when the install is scheduled and right after the install, they both could be right there in August. So you can see the difference. This is when you create the invoice. So you can see when I talked about that continuum, it can be anywhere from April to August based on when you decide it. And a lot of times people are deciding it based on poor money management that maybe they've made, and they're having to recognize it early because they need the profit early versus I'm going to recognize it when we've actually done everything we said we were going to do. And so you have to be really careful here because what happens is now that 37,000 is open to be spent because it's gross profit is open to be spent on company bills. So now a sale that you made in April, but haven't completed until August, if you recognize it in April, you have spent all the profit potentially from April through July before you ever complete it. And if anything goes wrong or awry, you have no profit from that job to go back to correct it. You're now going to have to take profit from another job to fix the problem.
Michelle, we have a question about this chart.
Okay.
The question is, when are you recognizing COGS in this chart? Because, and also like as a side note, different vendors have different payment terms.
That's right. And so normally COGS are recognized when you make the COGS payment.
Perfect. Thank you.
So it could be spread out. That's why we have to stop and look. And some people want to pay their cost of goods all up front. These days, with people going out of business, some people are scared to do that, or you better really know your vendor. Some people are paying, as mentioned, 50% up front and 50% at delivery, or 25 or 75 here. I mean, it's all over the place. And so cost of goods are going to be coming in and out. That's why most of the time we're wanting to try to manage for most companies. Again, this comes down to a decision. When do we want to recognize revenue so that it can be as close to the cost of goods as possible? How do we start to get these matched? Some people, it is difficult to match it all within a month, to be honest. Very difficult. So what a lot of people try to do is at least try to keep it within a quarter, so that they can look at things on a quarterly basis, right? Or a rolling 3 months so that you can start to see it. This is not it, unless you're cash accounting, rarely is it exact that everything comes in, which is why you have to keep track of that work in progress. What have I paid in? What have I paid out? And that's why the truth of your financial position is somewhere between cash and accrual. Accrual by itself is not going to tell you where you are. Cash by itself doesn't tell you where you are. In both cases, there have to be additional reports or additional information that you keep up with. You know, if it's cash, you got to know what's also coming. If it's accrual, you got to also know what was cash so that you can start to get the bigger idea of your financial health. You also have to have a good idea of when do you recognize revenue and profits so that I know that I am spending right now what I've earned. I had a client the other day who said to me that she had paid herself more than the net profit in her company. And so she knew that the more that she paid herself than the net profit had to come from one of two places. It either had to come from prior savings and prior profits, or it came from profit from a job that had not yet been completed. And that doesn't give you a good feeling because at some point it's going to run out. We can only take from savings or from prior or product and profit that we've not yet earned. We can only take it so far. You know when there's a problem. I've had drapery workrooms that knew there was a problem when the designer couldn't pay them up front a down payment or 100%, and they were running and chasing to get the next job to pay for the prior job. That tells me that all of these flows are not in alignment and working towards your financial health and your stress relief. So what the goal here is that your revenue recognition follows the invoice. That follows when you recognize profit, which means when profit can then be allocated through a Profit First or any other system to your profit, to bonuses, to making sure you got paid with an owner's draw, or all the multitude of things that net profit does in your company. Like, we can't even get it to net profit until that invoices come in. So if that money is being spent in advance, we're going to have a problem. At some point, it's going to show up. So let's talk about good practices. I just put strategy right up here at the top because every one of these are things that need to be considered and thought about. First, create a bank account to hold funds from clients that will be used to pay cost of goods. That's that commingling we don't want to do. We don't want to have access to that money to pay day-to-day needs of the business until we've earned that money and moved it in. So think about this as that liability bank account that we talked about. Another good practice is to have an account for sales tax, or to include that with the cost of goods in that separate account, so that that money doesn't get spent running the company and then the state comes wanting theirs for the sales tax. I'm telling you, I've seen it. I see it all the time, and it's miserable. The more that you can estimate that sales tax and put it into an account and hold it and make payment out of that account, it will never get commingled with yours. Sales tax doesn't even show up on the P&L. It does not show up because it is a pass-through account. So take that out and save it over to the side and save yourself a headache. Another good practice is to create a plan to recognize revenue and profit so that the profit can be used to run the business at the right time. That's the whole thing I just described to you, is when do we need that profit to run it? When do I create the invoice? When am I willing to pay the sales tax? When do we feel confident that we have, in air quotes, earned that sale? The next thing is to manage the sales tax paid and the items returned, which should align with your revenue recognition plan. Another practice, be clear on the money needed to run your business. Know what your company needs monthly to keep the doors open and to keep the business moving forward. Are your monthly bills covered by time billing, or by profit on product, or by a combo of both? We need to know that so that then you can keep up with your time. I don't care if you're doing flat rates. I don't care if you're doing progress billing. I just beg you, keep up with the time that you spend, because that's going to let you know how money should flow in and out of your company. Understand the implications of when profit from a sale becomes your money, when it moves from that liability account up to that asset account, so that then you can distribute it for the running of the company. Make a plan so that you're not robbing Peter to pay Paul, meaning have reserves, have a 3-month vault, do the good financial practices in Profit First or in other financial management constructs that allow you to put money aside, so that when and if you ever have to borrow, you have an opportunity to borrow from yourself instead of trying to go get a line of credit when you're just overwhelmed and things are falling apart. And then the last thing is to create that good money management plan that supports where the company is going and how you can direct your financials. Planning is not meant to tie your hands. What it's meant to do is alleviate stress and help you know, just like creating good budgets, creating percentages of how your money's going to be used. It's just directing in advance. If you think about it, none of us would go into a design project without a plan, not more than once. We wouldn't just go in and just kind of, shoot from the hip for everything that we're doing. We have process, we have plan. We're using project management tools that help us make sure we're not missing anything. We have to make those same strategic decisions with our finances so that it aligns with the process that you're running in Mydoma or Studio or some other project tool, so that at the end of the day, the money is showing up where it should show up at the same time that the work is being done, so that you know that you can feel good about the next decisions that you need to make in your business. So here are some tips to align revenue recognition with your workflow. Know how your process flows money in and out of the company. That's not enough. You got to know a little more. Know when the money's recognized. Is it yours or is it theirs? and then understand the challenge of acknowledging profits for use and the timing of it. So the strategic decision here is to flow chart, like literally flow chart. When does money come in? When does money go out? How much does it cost me every month? How much money do I need to have available? Where does money need to be sitting in a profit account or in a vault account so that I can strategically make decisions about how money is moving in and out of the company, and I can make decisions from a place of strength and not from a place of, oh my gosh, there's money in the bank account, but I don't know if it's mine or if it's my clients, and who gets the money. I don't know how long it's supposed to last. Those decisions create a stress that doesn't need to be there. And so this is some of the strategic work and decisions that I teach and that we do that help you make a plan in advance so you know what's happening. What questions might we have, Jamie?
Not any so far.
Okay.
We can keep going.
Yeah. So one of the things that I'll do as we wrap up, and if you all have questions, please feel free to drop them in and we can talk about any of them. But I am Profit First certified and have been since 2015. And I teach Profit First with a bent towards the interior design industry. And so what that means is understanding how your work flows in and out, understanding how your processes work. You can't just sometimes, unless you're doing straight cash accounting, go pick up a Profit First book, go get 5 bank accounts and implement it. It doesn't work that way. And so many people have told me over the years, I can't do it. It doesn't work. Well, it does work. But the truth is it has to be aligned with your process. So just like everything we talked about for the last hour, I can't start recognizing profit on a cash basis if I'm not really recognizing profit until the end of the job in an accrual basis. It doesn't align. So we have to align your profit first with the way that you're working in your business. So if you don't know how you work in your business, you'll struggle to know how to allocate profit and to make the numbers work for you. And so that is what I am getting ready to teach starting in May. We're going to be teaching Master Your Profit, teaching you how to do it, whether you're cash accounting or any of those steps in accrual accounting, helping you make the strategic decisions and then the tactical decisions to know how to move and allocate your money. But whether you choose to do Profit First or any version of money management, I mentioned some of those opportunities for like separating out your cost of goods in another account or sales tax in another account. Regardless of what you put in place, it's creating that first strategy in your business and then aligning everything with it that makes everything work together smoothly. If you use the scan code there or the discount code, it will give you $100 off if you would like to participate in that. It is 8 weeks. There are 4 live group coaching calls, and then a community that you can ask questions along with the education to go with it. Jamie, any other questions?
Not so, oh, looks like we have one last one. We have the question, does Matrique fit into this?
Yes, Matrique fits into the Master Your Profit. So what we do in Matrique, so I can talk about it from both standpoints, again, whether you are using Mydoma or Studio, because we integrate with QuickBooks and with Studio. And so Matrique, what it allows you to do is to bring in your profit and loss statements and your balance sheets. It allows you to set up your Profit First percentages. It allows you to then distribute those funds, or at least do the work to tell you what to distribute. You can then mark that it's been distributed. And our next release coming out at the end of this month or in May, we have full cash flow, so you can manage all of your cash flow in there. We also have financial models where you can start to set up models of, if I were to hire, what would happen? If I were to fire, what would happen? If I want to move out, if I want to sell more, if I want to increase my markups, if I want to decrease my margins, if I want to change how much I'm selling or the amount that I'm charging. So we have all of those modeling tools over there that are meant to be an adjunct to your business and to the financial software that you're using to manage the day-to-day, so that you know how to take the data and interpret it to actually make the decisions you need to make to move forward in your business. Because most people are looking at their reports coming out of their financial programs, and they're like, that looks great. But now how do I pull those numbers and that information together to make a decision. So Matrique is meant to be a decision maker tool to help you decide those things. So it certainly runs right alongside all of this.
I've actually seen it. It's very cool. It's very, very cool. And before we wrap up, actually this afternoon, we're going to run a quick poll. Let me actually just launch it here. So if you would like to learn more about Studio Designer or Mydoma and how they could help you run a more profitable, efficient business, please click yes to the following poll, and I'll launch it in just a sec. Or if you're curious to learn more about, we could do or you might want to learn about both. If you're curious to learn more about Michelle's financial coaching and tools, including Matrique, click yes to the following poll here as well. So I'll launch that and give people maybe about 30 seconds or so before we wrap up.
And Jamie, I see 2 more questions that I can answer very
Yeah,
quickly, if
please
that's okay?
do. That would be
Yeah.
great.
Yeah. So one question is this program for both cash and accrual accounting? If you're talking about Matrique, the answer is yes. We help you manage in cash and in accrual. And then the next question is this course suitable for a workroom, not an interior designer? Absolutely it is. It is meant to teach you the strategies so that whether you are an architect, a builder, a designer, a workroom, a pipe layer, I mean, it doesn't matter. It's about teaching you how to take the strategy and implement it with the way that you run your business. And honestly, every single thing that I described as well holds true for a drapery workroom. So if you're on this call and you heard that continuum, yours is just, do I recognize it as revenue when the designer gave me my money? Do I recognize it as revenue when we got all the pieces and parts in and we put the work on the table? Do I recognize the revenue when I call the designer and say, come pick it up? Or do I recognize it as revenue when the designer picks it up? So it is the same idea. It's just at what point in your process does this happen?
All right, I think we'll wrap up as we are just over time. First of all, Michelle, thank you so much for the wonderful presentation and for braving through it with your recovering laryngitis. It was super helpful. I learned a lot, so I hope you all learned a lot as well. For those of you in the audience, stay tuned for our next Work of Design Live webinar coming up in May, which will be focused around communicating your value. So stay tuned for receiving an invitation to register for that. And don't forget to register for Michelle's Master Your Profit. As she mentioned, you can scan the QR code and register that way as well. But Michelle, thank you so much again. We really appreciate you doing this for us. And wishing everybody a great rest of your week.
Awesome. Thank you so much, Jamie.
Take care, everyone.